are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletters. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, we're good to go. Let's see. All right, I have to share my screen, and we shall be all set, hopefully. All right, let's see. Bring up the chat window, and I'll be able to see you guys. What is that? Go away. All right, cool. All right, so hopefully you guys can see my screen now. We will look at my, it's not very interesting, that one. Now we're looking at the Thinkorswim screen. And let's see what we got. We have the Nikkei. For us futures fans, let's start with that. We have the Nikkei at our shorting spot, which is 17.8. It's in an uptrend, okay? We're not happy about it being in an uptrend, but why does the Nikkei tend to go up? The Nikkei tends to go up when the dollar goes up, because the dollar going up makes the yen go down, although down is up on the yen, so that's very confusing. Here's the yen in an ugly chart, but okay. The yen is getting up to 119 plus, and so in other words, this is more yen per dollar. It's different than most of the charts. So, well, it's not different, I'm sorry. This is less euros, I'm sorry, it is backwards. This is how many yen you get per dollar, whereas this is how many dollars you need to buy a euro. So you only need $1.20 to buy a euro. So when the euro goes down in direction, it means it's getting cheaper to the dollar. The yen, on the other hand, since you get 119 yen for the euro, that chart goes up as the yen gets weaker. So it's very confusing. It's confusing to talk about. It's confusing to look at. There are lots of problems with trading yen, which is why I don't like currency trading in the first place, because you get so mixed up. But in the grand scheme of things, what I'm saying is I don't think the dollar is really going much higher than it is now. It peaked out right about here earlier in the day. I think the Nikkei is tremendously overextended. So it's the kind of thing where I think that I have conviction for shorting it overnight. So I really would like to especially see how it touched 17,835. So I'm really kind of into shorting it right here. If you're playing with tight stops, you want to use this line and really obey it, though. Like, don't play the over. It'll come under and you'll get it. So there's no reason. You're better off losing like 5 points each time, which is $25, $5 per point on the Nikkei. You're better off losing $5 a few times or $25 a few times until you get a hit, because your hit's going to be a biggie. Your hit's probably going to be a 100-point drop or so on the Nikkei when you catch it. So why take big losses when you have this big $500 payday ahead of you? There's no point to taking a big loss. So that's the in and out way to play it. So in other words, you just keep shorting of that 17.8 line, and if it ticks over, you get right the hell out and wait till the next time it goes under. Or you can play it with conviction. Now, I play with conviction because I have, enough money where I don't really care. So it's a different thing. I've got enough money in my account where I don't mind playing the thing with some conviction, but we'll go to the active trader. All right, and we'll take a look at NKD. So who are we going to ditch? Let's ditch the NASDAQ. It's a totally silly thing to play. So we're going to do NKD, because why play the NASDAQ when you may as well just play Apple? Why am I waiting? Oh, because I didn't put my flashy thing in. There we go. All right. So I don't mind playing with conviction, so I'm happy to sell one at 17.8, and I'll put that in right now so we can watch. And I will plan, where's the next point of resistance? It's 17.820. So I'll plan to sell another one at about 19 if this fills. And there is no 19, there's only 20. So I would plan to sell my second one at 20. That'll average me in for 2 at 10. Then what do I think the high is going to be? I think the high is going to be 40. So I might sell another one at 30 and then see what happens. And unless it breaks over this 45 mark, I'm probably not going to do anything. I'll probably stop out over 45. But if it's staying under here, I want to have 3 to 5 over here. And that way, if I catch this ride from 8:30 down to back to 17.7. I'm getting a 100-point run, so I make $500 times 4 or 5. Excuse me. Or so let's say 3 to 5 positions. Or if I'm unlucky or lucky, depending on how you want to look at it, if I'm unlucky and it goes straight down without me having a chance to accumulate it, then I'll have one and I'll make $500. I'm not upset about that. Oh, I got my fill. All right. So while I was talking, that one filled. My next one I'd want to enter. You can only enter in increments of 5. So my next one I want to enter is at 17,820. And if that fills, it means it's not doing what I wanted it to do. But like I said, I'm kind of playing off this line being solid. I really don't think the dollar's going much higher, and that means I don't think the Nikkei is going much higher. It already tested this line and failed it once, so I'm going to kind of put my eggs in that basket that it's more likely to fail than not. I'm not going to put in a hard sell here, though, because this is what happens to me in these webinars. As I'm talking to you guys, I'm not paying attention, I get screwed. So, so it's like, it's not like I don't care about losing $100 or $500 or whatever. I do care, so it's like I would rather not. So let's just see how this plays out, and we'll check back on it later. But as a plan, my plan would be to sell another one at 20, which would average me to 10. And, of course, if it then dips to 10, I would get right out, and I'd have one at 10. All right? That ideally is what we want to do. What else? That's it. Okay, so there's that. Are the other guys in good positions to play? No, they're not really. I mean, you've got the S&P sort of drifting over. It might, I mean, if you want to be bullish, this is a good bullish line, 2060. It lined up with 17.8, and then you've got this one now, TF. Now, if I wanted to play bull, if these guys keep going up, and since I already have a short, it's a good idea. If these guys keep going up, I'd want to play the Russell over 1165. But I think that's more of a resistance than a support, and I think that these guys are going to come back down. I think everybody's going to calm back down a little bit in the afternoon. Europe had a pretty good session. Do I have the Wall Street Journal up? No, I don't. Let's see. Let's try WSJ, see what comes up. What are you kidding? I am a subscriber. How dare they? Apparently not on this computer. How do you get on it? WSJ. Let's try that again. Online WSJ.com. There you go. All right, so in Europe today, we had not such a great day. London came back nicely, but they had a bad day yesterday. The rest of Europe was kind of flat. But what's more important, I like these charts in the Times. I'm sorry, the Times in the Wall Street Journal. Because it's just nice to be able to go like this. Like quickly look, DAX was down all day, CAC was down all day. FTSE was kind of I'm sorry, not FTSE. It's confusing. This is Italy, and they were kind of flattish, up and down. And then Spain had a good finish, so they were okay today. And London gapped up, but never really went anywhere. So this isn't a super strong look in Europe. Asia was crazy because the Shanghai jumped up 3% because they began cracking heads. And you'll see the Hang Seng did the same thing. See the Hang Seng? Because they started busting heads in Central Square in Hong Kong, and the protesters gave up. So now that's like great because the commerce comes back and they'll be able to sell stuff again. It won't ruin Christmas. All those things. All participants. Yeah, hi, Wayne. Yeah, all participants is what we use in the chat. I'm not sure what all attendees is. Oh, all attendees would be not to me, I guess. I didn't think that's what it means. So the gist of it is please use the one that says all participants. And that way everybody can see you and it doesn't look like I'm talking to myself. And let's see. All right, cool. All right, does anyone have any questions? I don't really have a topic today. I'm just kind of like looking at some stuff. It's not a very exciting time of year to be trading, and you can tell by our chat room is like devoid of people practically. I mean that's good though. It's like, look, we all went to cash. We don't have a lot invested in the market right now, or most of us anyway, and we're not looking to be heroes. It's Christmas time. It's like relax, check out the market, have a little fun trading, but this isn't a serious time of year to be trading. The market's just thin, and there's not much going on, and everybody's just sort of winding down into the holidays. So it's not a particularly big time of year to be doing stuff. But there's always, if you want to, though, there's always something to trade. But this is a great time for you guys to ask me whatever you're into, because that way I can spend some time on it instead of jumping around from thing to thing. Let's see. So we talked about that. Now let's look at the bigger picture. So we're watching that dollar, and now my premise on the short Nikkei is the dollar is going to stay under 88.70. If the dollar goes over 88.70, my premise is blown. Whenever your premise is blown, you need to get out of your trade. There's no point in staying in a trade when the reason you went into the trade is no longer valid. So the Dow, we have 17,850. Natural gas we were watching earlier, that's just gotten weaker and weaker, though. We tried to go long on it twice and it hasn't worked. So that's a bad trade. And so that means, look, my premise on natural gas is it's going to get cold at some point during the year. I do like that premise. But natural gas is not trading well. And if we go to a longer-term chart on natural gas, I don't have a good long-term chart. That's a shame. You think I would have one spot where I can do this. How about here? Nope. I do not have a good long-term chart on natural gas. Forex. No. Oh, yeah, I could do that. Watch here. Do this. All right. At least that's something. And we're going to take that away, and we're going to go to our, whoa, no, that's not what I want to do. Load style, there we go. And now we're going to change our time frame to hours, there we go. All right, so the thing about 385 on natural gas is that it's not really support. It's kind of good support around here. All right, and we really bottomed out at 350, but 350 with natural gas, it's how much is it? It's $100 per penny. So you really you look at this and say, well, it's only fall to 350, but that's like $30,000 below the current price. So you don't want to mess around too much with natural gas if you're not very, very confident about which way it's going. Already we've lost, not a penny. I mean, obviously, hopefully people stop out before that. But we lost 20 bucks here and 20. We tried to go long at 4, lost on that, so figure, down 20, 30 bucks. Try to go long at 390, lost again, 20 or 30 bucks. And now we're looking at 385. And I want to keep going long, though. I mean, honestly, the thing about natural gas is if you catch the right one, you can get a real explosion. Let's see if we can find something less ugly than this, maybe the hour chart. There you go. So if you catch the right time on natural gas, like see here, where we held through, where it pops over 4, it does, it's kind of a base. Once you find the right line, it obeys that line pretty well. And now understand though, this is down here at 394. That's a $500 drop. So you got to really be able to stomach some moves sometimes on this thing. But you take it on this line, and if you catch the right move, you go, it went up, it never came back down to your line, and it goes all the way up here, and now you're talking about a $3,200 gain. That's the kind of moves natural gas makes, but you don't want to mess around in the middle if you can avoid it, because the middle will kill you. But you catch a move off a bottom. Here again, $4 was excellent support. Big move to 450. Earlier in the year, we were short natural gas when it was like at 480 or something crazy, or 5 something. I forget what it was. It was at some crazy high number that was ridiculous. We shorted it with conviction, and that was a gigantic move, like $50,000 or something. Well, I think it's 10 contracts, so $5,000 per contract or something like that. That's a great way to play. But it's like fishing, you get a lot of nibbles, but then you get a bite, and you got to play that bite. You got to know the difference between a nibble and a bite and let it play out. So far, so what we're doing now is we're nibbling at these lows and hopefully trying to catch one. So far, not working. But that's the way you want to do it. It's like every nickel on the way down. And now understand that. Now, we're talking at the bottom is really, what do we say? It was 350, let's say, is the real bottom, right? Because that was the low that we saw. So at 350, I begin to put a little bit of conviction into the play, but right now it's just like nibble, and every time you hit a 5-point, you nibble, and you're going to lose 20 bucks, 30 bucks, 20 bucks, 30 bucks. So if you lose 30 bucks every 5 cents from 4 to 350, that's going to be 5 times 30. You lose 150, but so what? Because all you got to do is catch one nice move up for a penny, and you get all that money back. All right, so you just have to understand the dynamics of what you're playing. You know, it's kind of like, I mean, look, it's like roulette. It's like you say, okay, well, not that I advocate roulette, it's like the worst game in the world. But conceptually, if it was a fair wheel, if it didn't have double zeros and things like that, if it was a fair wheel, you got 36 numbers, you get paid 36 to 1. You don't. You get paid 35 to 1, so that's a rip-off right away. But if it had 36 numbers and you get paid 36 to 1, and you put 1 on the same number time after time after time. Of course, statistically, sometimes it'll never come up for ages, sometimes it'll come up, but over the course of a billion spins, you're going to win 1 out of 36 times, and you'll get your money back, essentially, if it was a fair game. It's not, because not only do they only pay you 35 to 1 when they should pay you 36 to 1, but then they add 2 more zeros. You know, they add 0 and double 0 on the wheel. That knocks your odds down. Don't forget, that knocks your odds down by 3%. Adding 1 more number to 35, 36 numbers knocks your odds down by 3%. Another one knocks it down 6%. Then they don't pay you 36 to 1, they pay you 35 to 1. Now you're 9% disadvantage playing roulette. Every time they spin the wheel, you have a 9% disadvantage. That means they're essentially taking 9% of your money every time they spin. That's why it's the stupidest game in the world to play. Yet you'll see people lining up at that goddamn thing. All right, that's my rant on roulette. Don't ever play it. But that goes back to our whole overriding concept, be the house. It's like, yeah, roulette's a stupid game. How do I get to open up a place that has roulette wheels and let people play? What kind of, you have a 10% advantage. You have to be unbelievably unlucky not to make money when people play roulette against you. But you also have to have enough money to be the bank and make those payoffs, and that's what we do with options. We sell the premium, we take those huge edges in our favor, and over time they work out. Sometimes they don't work out. There's no guarantee it's going to work out. If I'm the house and I have it, this guy comes up to my roulette wheel, I'm the house, and I'm saying, okay, great, I'm going to win 10% of this guy's money. Guy puts down 1 bet, bets on number 1, I spin the wheel, 1 comes up. What happens? I have to give him 36 times his money. All right? That's going to happen. It only, the system only works if I play enough people. It doesn't have to be the same guy. I just have to play enough people over time so that the law of averages kicks in my favor, and I do get 10% of all the money played. But I only get 10% of all the money played over time. In any given instance, I can lose 36 times the money played. So you have to look at that and address your risk. We were just talking about that with BTU, for example, was in the $25,000 portfolio, and it was also a top trade alert from early November. Now the problem is, well, first of all, it's my fault in the $25,000 portfolio, because what the hell was I thinking? It jumped up to 90 cents out of $1 possible. That trade jumped up to 90 cents. Why did we not take that off the table? It's because we weren't paying attention. And I'm sorry, because I don't pay attention because I have 1,000 things I'm doing at a time, and it was in the 25,000 portfolio. I just didn't happen to look at it. No one mentioned it, so we didn't do anything about it. But when you have $1 spread and it goes to 90 cents, you take it off the table. Because you know what could happen? Exactly what did happen to it. Now it's worth 30 cents or 25 cents. So we'll look at that. We'll look at that shortly. I'll look at the portfolio. Let me answer some questions now that we have them. Okay, Baylor roll the DXDs. That's a good question. That was in one of our portfolios, right? Is that the 25 KP? Is that what we have? Or do we have in 2 places? I think we have in short-term also. Ah, there it is. Short-term portfolio. Is that current? Whoa. What the hell is that? Advertising. You're kidding me. I pay you people. How do you advertise at me? Let's see if we're not even signed in on this, so I don't know if that was an accurate number. Portfolios. Loading more advertising. Oh my God, I'm going to write these guys a letter. All right, $25,000 portfolio, DXD. Yeah, this is not good, and we should adjust it. But before we adjust it, we don't knee-jerk to adjust things. We have to think about why were we in that trade, what did we think was going to happen, and what do we think is going to happen. just because we lost DXD. So in November, we thought the Dow was going to go lower. So let's take a look. Stock charts. What is this crap? Things putting up ad after ad after ad. All right. So the Dow did not at all. It didn't even budge. Not a single move below. Okay, so it's just like not working out. Do we still think we're going to have a nice sell-off? Well, here's what I think. I think box and a half. Okay, whatever you call it, it's a line and a half. So how often is the Dow a line and a half over the 200-day moving average? Holy cow. How often is the Dow over this 200-day moving average? By 1.5 lines without correcting. Here's not even 1.5 corrected, not even 1.5 corrected. Here's 1.5 corrected. Here's 1.5, little correction, then went up even worse, but notice it was still not much more than 1.5 corrected. Well, I mean, no. Okay, here's a bad example for you. It was up 1.5, went up worse. This is like 2+ over 2 handles here. Here, again, 1.5 got worse. All right, so the Dow can disappoint you here. So, first thing to take into consideration, we can get burned on this play because the Dow can go much more stretched than we think it can. So this looks stretched and it feels stretched, but the reality is we're not in an unprecedented zone of high. If you look here, if we were up 2.5, I'd have some serious conviction about shorting it, but we're not. We're 1.5. And notice this thing, these are oscillators of various kinds. These have been much higher also, so we're not really peaked out here. This red line is nowhere near peaked out. You look at the CMF here, also not peaked out. You got your PPO up here. This one looks like you might be exhausting a trend, and of course, overall, we're pretty darn overpriced. There's no particular thing that stops the Dow at 17.9. You know, we had 17.9 over here, but that's not really a number. It's not a big thing. 18,000, I think, might be a good point of resistance. So we don't think it's going to go much higher, but we could go higher. There's nothing particularly stopping us from going higher. It is a thinly traded time of year. So it all goes back to, I wouldn't want to spend too much money on it, but I also don't think I want to give up on a DXD short. It's just too much fun. So that being the case, now we have to take in price into consideration. How much is this decision going to cost me? Well, I've already spent $2,600, and we'll get $700 back if we're lucky. So, you know, we have to decide that also and say how much we really want to plow into this kind of trade. And also, I want to look at, you know, what's our expected payoff. And let's say the Dow, well, see, with the Dow, it's interesting because 1% of the Dow is 170 points. That's a pretty good move. 1% of the Dow is going to be only 2% of DXD, and 2% of $21 is what, 44 cents, 50 cents. So with these are the 22 calls. 50 cents, though, will put us in the money. All right, so we don't need a big move, but we'd like a little move. Maybe we'd like to buy a little bit more time. So let's see what it costs us to buy more time, buy more position, and we'll decide what we want to do with that spread. So DXD. All right, and we have the December, what are they, 20s? No, I wish we had the 20s. We have the 22s, and they're about 40 cents at the moment. That's not so bad. So they're a little better than they're showing us on our spreadsheet. And if we wanted to buy a month, oh, that's expensive. See, a month is going to be 70 cents. 68 was the last call. So a month is going to cost is 70, and we're at 35 or 40. So it's going to cost us double. We had to double up, basically. We spend another $700 to buy a month. On the other hand, and I think I did just say this to somebody about DXD. Hang on, let me just double check. I'm sure we had this conversation in chat. Nope, I didn't. Isn't that weird? All right. Since I feel pretty confident that this should be the top for the Dow, or at least there'll be a pullback before they go past 18,000, and I think it's going to happen before January, but then the January expiration is when? Let's take a look. January expires on the 16th. That doesn't seem so, it's not very long after New Year's. After that, you get into earnings. Really kind of in between on that at the moment. Then, if we roll to the 21s, those are like, I wouldn't pay $1.30. I'd offer like 120, maybe 125. Okay, let's say 125. So if we get 35 for hours, is that what we decided we were getting, or 45? 40. Okay, if we get 40 for hours, and we spend $1.25 here, it costs us 80 cents to roll down $1. But see, there are 80 cents in the money then. So we're kind of eliminating the premium. And then if we get a move to 22.50, we know we're locking in at least $1.50. All right, but but now I want to say there's probably no point to that. That's not really, so what? That's not that sexy. Because like, okay, so I get $1.50 if it goes to 22.50, but you know what? That's only going to make me back, because I would have spent my original, what was it, 70 cents? No, what am I talking about? Look at what we spent for those DXCs. We spent $1.30 on them. So I spent my original $1.30 plus another, I'm sorry, remember now, $1.30, I'm sorry, 125, so another 85. So we'd be spending $2.15 on these guys. Just to be in the January 15th. So I really want to spend $2.15 to be in the January 15th? No, that's not exciting. So I don't like that roll. I wouldn't want to spend that money. I'm not positive it's worth even spending the, I got to think about it. Is it worth spending 70 cents minus 40 is 30. Is it worth spending 30 cents to buy another month? That seems worthwhile. We're going to be in it for 160. It's at 80. The delta is 50. So we need a $2 move. We need a 10% move on DXD, which is a 5% pullback from the Dow, just to get even. So it really comes down to how likely is that to happen. And I would say, given the fact that it's only December 1st or 2nd, and we've got till the 20th for these things to be active, I think we should put this decision off. All right, so that's my logic. If you're looking at it now, I'd say let's wait a week, see how the Dow's holding up, and then decide, because it can't get much worse. We only got 40 cents left in the trade. So it might, if we get lucky, if the Dow quickly drops, we're not going to miss anything, because we'll start making money on these guys, because they're practically in the money. If it goes the other way, I don't want to be in this one. Why would if I spend more money to get in that trade and it goes the other way, we're just going to lose more money. So there's no point. There's no benefit to the roll. All right. So I guess, Craig, your original question is, when do you bail a roll? Well, the answer is when we feel like there's a more of a reason than we have today. On the whole, though, bad trade. I mean, it's just a bad trade going bad. But at this point, down already to 40 cents, there's really not much point in jumping out of it until we get a little bit more data. Let's see. Wayne says, what is the difference between a bear call and bull put spread? Holy cow. All right, bear call spread. There's not really a lot of difference. It's about your premium. I frankly, all right, I'm sorry, let's, in case anybody's confused about that, a bear call spread means you're taking a call spread and you're being bearish on it. So you would be short the call spread. So let's say, let's find something that's not so crazy with the options. Let's do DIA. Oh God. Wait a minute. Good. All right, here's some numbers we can work with. All right. So if you wanted to take the, well, no, we need something with easier numbers. I'm sorry. Damn it. What did I think of as going to be simple to do this with? How about OIH? Does that make any sense? Yeah, that's a good number. Okay. All right. So here's OIH. It's a 37.50-ish. Now, if we took the 36.50 calls for $2 and we sold the 38.50 calls for $1, we have a $1 spread, right? So if we want to play it bullish, that's a bull call spread. We buy the calls, we sell the higher calls, and we're bullish because we want it to go up, and we'll end up getting $2 back for our dollar. This is actually a really nice spread, considering if you want to be bullish on OIH, if you think about it, if you spend $1, it's actually $1.10. But if you spend $1.10, you have 90 cents of upside, and they are in fact $1.10 in the money. So there's zero premium for this spread. It's actually a very nice spread. So we can buy, that's a bull call spread. That's the basic. Now, when you talk about a bear call spread, it means that you're buying the 38.50s for the dollar, selling the 36.50s for $2.10, which effectively makes you short. The most you can lose is 90 cents because you're collecting a 110 premium. So if it goes up, you'll lose 90 cents. You'll have to pay this guy $2 basically, and you only sold it for 110, so therefore you're going to lose 90 cents. If it goes down, you can make 110. The same thing though. It's in the same position. There's no premium, so it's kind of nice to play that way. Now, that's a bear call spread. It means you took a call spread, you took the bearish side. On the put side, a bull put spread would be the same thing but selling the premium. Now, it depends on your premise. If your premise is OIH, see, here's $1 and here's $2.10. It's the same thing. The 37, well, let's see what 37.50 is. 120 and wow, that's a big spread. Let's see if interest is a bigger number. Here'd be a $1.25 difference. I'm sorry, $1.15 difference between the 37.50 and the 39s. So if you wanted to have a bear put spread, you would then be buying these puts. You bearishly are selling these puts, and you want it to go down, and you would make the difference between $1.25 and $2 on the way down. If you wanted to take a, Jesus Christ, a bull put spread, you'd be doing the same thing, except you'd be buying the 37.50s for $1.20 and selling the 39.50s for $2.35, so you'd be getting your 115 credit, and you want it to go up and make your get to keep your 115 because this guy would expire worthless. All right, but just from that explanation, I hope it's clear that it's annoying. It's too many stupid things. And if you start filling your portfolio up, and I learned this from experience, okay, I would say to you that I would go with the one that has the better margin, because one of these has a 15-cent better spread than the other. One gives you nickel spread. One gives you $1.10, one gives you $1.15. So of course, whichever way you want to bet, take the one that pays you a nickel better. That's in a vacuum. But the problem is, when you start filling up your portfolio with bull call spreads, bear call spreads, bull put spreads, bear put spreads, like that, and you will not know what the hell you have in your portfolio. You can look at it and you will go cross-eyed and blind. So the difference is, stick with one thing that you play and play it. Because that way you'll actually understand your portfolio when you look at it. When you start having a dozen different kinds of spreads in your portfolio, I guarantee you will never make money. You will just sit there and stare at your portfolio like endlessly trying to figure out what you have in it and what you're doing and what you should do. Right? That's why we, especially with the portfolios we're managing, virtual portfolios we have at Phil Stock World, I absolutely I not only advocate, I don't mess around with like all these different things. If we want to be bullish, we take a bull call spread or we buy calls. If we want to be bearish, we take a bear put spread or we buy puts. But we don't take, we don't sell bull call spreads. We don't sell bear put spreads. Because or whatever, vice versa. You see, I can't even explain without being confused. We don't take the opposite of things. Just it's too annoying. Got more things to do in life. You know, it's almost it's like asking a mechanic. It's like, why do you just turn the, why don't you just use the lug nut and go like this and turn it? Why don't you just do this fancy dancy thing and do it because it would be more efficient? It doesn't matter if it's more efficient. It's easier. You pick up the damn thing, you put it on, you go like that, you're done. There might be better ways of doing it, but sometimes you just want to use the right tool for the right job and be finished. So, if you're more comfortable with one or the other, if you think there's a benefit, that's fine. There's arguments to be made for every single way you can go. And to me, I said the ultimate argument is which one pays me which one pays me that extra nickel. All things being the same, it's the same. It's just a different way of doing the same spread. So on XRT, you could use either to short the ETF and one preferable to the other. So no, neither is preferable to the other. They both do the same thing, but they just do it in a different way. So it's just a matter of saying what pays me the best on this thing. All right, where are we? Okay, I should check on my Nikkeis just in case anything's happening. It is your responsibility, you chat people, to tell me when something is happening. Let's see, charts. Yay, we're making money. Look at that. All right, so yay or boo. This is what I was trying to tell you guys. I'm not really happy because, frankly, I like to bet much higher amounts. But what happened here is the ideal thing that happens is I took one position and I already made $175, right? It zoomed right down and made $175 like in 10 seconds or whatever it took. I did not get a chance because it only hit 17,815. It never made 17,820, not that we were paying attention anyway, but it never made enough for me to want to double down. So I just have the one that made money. But you know what? That's nice, right? Isn't it nice to make $175 in, I mean, how long have we been doing this seminar? Maybe 15, 20 minutes we had this thing? That's what you want to do with these futures trades. You make a quick trade like that, you make some quick money, you get out. Now, what do I do when I'm making money? I check my premise. What was my premise? Dollar. What's the dollar doing? Well, let's find out. Ooh, it's actually not going down. It's at 675. It's right where I don't want it to be. But the Nikkei's falling anyway. So I think the Nikkei's falling because the dollar is not going higher already. I think it's already disappointed. So now we're going to watch at 765. And we're going to see if it keeps going down or not. But I thought that it was going to break, and my premise was it was going to break down and trend back down to the 17.7 line. So we'll see what happens. I really should put a stop here. If I put this stop here, it'll fill in 2 seconds. If you put in a hard stop, they will take your stop because they don't want to pay you. The guy who owes me $175 would love to pay me $165 instead. All right? So you don't want to put in a hard stop if you don't have to. And frankly, and again, I wanted to have 5. So I wanted to make $2,500 on the move down. I didn't get my 5. I only got 1. All right? So for me, making $175 or not making $175, I could really care less. It's not the trade I wanted. That's my perspective on the 175. If, on the other hand, I was a small trader, and I'm not small, I don't want to say small, it's insulting. If I'm a small trader and I'm just trying to make some money, and if $175 did more than get me a nice dinner, all right, if it meant more to me than whether or not I go to, whether I go take my kids to sushi tomorrow or not, I would absolutely take the 175. I mean, that's fast money, it's great, and there'll be more setups to come. All right, I always want you to, I think that's important to put into perspective. I realize that when I talk to people out in Vegas, it's because, look, some people have more money than others, and some people have different goals than others, but it's so easy to make $175 and then make another 175 and another 175 if you take it off the table. But don't lose your 175 because you dream of 500. That's just stupid. I didn't expect to make $175 this quickly, so I should take it off the table. And frankly, if I had 5, I would certainly have taken 3 of them off by now. But I only have the 1, and I still kind of have faith in it falling some more. So I just want to see how it plays out. All right, but the smart move would be to take this freaking money and say, great. And you know what? You take the money now, and if it goes below 750, you get back in. So what do you miss out? $15. I'd rather miss $15 on the move and lock in $160 of profit, right? So meanwhile, back to the drawing board. But so like I said, so this trade technically worked out. As I said, I would have put a stop here at 1775, and if anybody happens to be watching, I'd appreciate if you keep an eye on that for me. But the bottom line for me is, like I said, I was looking to make $2,500. I'm not going to make. There's no way I'm going to make $2,500 on this now because I only have one contract. I thought I'd have 5. But that was my actual goal, was to build up to 5. Didn't work out. Only have 1. I'll make $500 if I'm lucky. All right, but then I'm sorry, not even 500, 250. Oh, I just realized that. Stupid. I was only planning to have 1 contract. No, that's 500. I'm right. No, sorry. All right, so 1 contract, 100 points is $500. So 500 is my max gain. I'm not at half my max gain yet. I'm not satisfied. It's reasonable for me in the proportion that I trade not to be satisfied with 175. But again, that's because $175 is what it's going to cost me to take my kids out for sushi tonight. So I've accomplished a goal. All right, I have a bigger goal. I'd like to go. My daughter asked me if we can go see a Broadway show, and I said, okay, I'll see how my trading goes. So I would rather make $500 and be able to take my daughter to a Broadway show on Saturday than take my family to sushi tonight. So that's what I'm playing for. But if you're playing for like a car payment or a house payment or whatever, then you should be taking the goddamn money off the table. I cannot be more clear about that. I mean, you really have to be in proportion to your actual income, your wealth, and so on and so forth when you're trading. All right, Christy said, I thought you always want to be the house, so why do you buy a bull call spread? Okay, Christy, the point of being the house is not to pay a premium or to sell as much premium as you can. It doesn't mean you always short everything. Sometimes you want to be long. All right? So you can't take things and make them, I mean, don't be absolute about things that I say. That's not the intention of when I say something. We might say something like, be the house, okay? And we say, oh, be the house, not the gambler. Sell premium whenever you can. Yes, but what am I doing in a bull call spread? I'm selling the premium. In other words, going back to that thing that we were talking about, what were we trading? OIH. So if I buy the OIH 3650s for 210, what am I paying? I'm paying $38.60. I'm paying $1 in premium, right? That's a bad play. That's what I'm telling you not to do. Don't be the idiot paying $1 in premium. But I want to be bullish on OIH. How do I do that without buying premium? Well, it's easy. I take that same 210 and then I sell the 38.50 calls for $1. Now I'm in the 36.50s for $1.10 and I paid $37.60. Where's OIH? OIH is at $37.72. I'm 12 cents in the money on the spread. That's what being the house means. I sold the premium to somebody else. I don't have any premium. I own the stock. I own the stock for the price of the stock. In fact, I even got a 12-cent discount to where the price is now. So I am being the house. I already sold this sucker money. I'm sitting here with no premium. I have no time risk. I obviously have the position risk of it going up and down, but I have no time risk, and that's the key. All right? That's not the same, though, as the strategy that we use in like the butterfly portfolio where we're selling, we position ourselves to sell so much premium that we're playing that roulette game, essentially, where we just keep taking money. But again, just because we keep taking money doesn't mean we're not going to lose once in a while. In fact, right now I think we're down quite a bit from the change in in the options. All right, but that's going to happen. You can't always win, but over time you can do very well. All right. So you own Pato. I don't know what the hell that is. And I was wondering, is that a Toronto stock? Is that what you think? And I was wondering if you have any opinion on it with regards to holding it or not. I got it in 35.0. I don't know. Is that potash? Wait, let me see. Can you answer? I'll go down to the bottom. Chrissy says yes, so I assume that is potash. All right. Where are we? Okay. So you own Potato, and if it has any opinion with regards to holding 35, I don't really have an opinion on potash. I don't like potash very much because it's not a real thing. Like potash is not. It's like a fake commodity because it's what the hell. Go away. Help. You know what happened? My kid got a hold of this computer again when I was away in Vegas. My kid got on the computer, and now it's full of like stupid little virusy things again. You know, which I had them cleaned out, and now I get all these little pop-ups that constantly come up and annoy me. All right, let's see. Oh yeah, where's that ad blocker? Is that not working? All right, I'm going to have to check this out later. I'm supposed to have this thing called ad blocker that stops all this from happening. Jeez. All right, so where were we? Potash, right. Okay, so the problem I have with potash is not really a rare thing. It's very easy to produce, and it's really just a question of supply and demand. I think that you're in a good spot on the demand curve for potash, but I never think potash is worth a lot because, again, like if it got expensive, a lot of supply would come online very quickly. So it's actually good that there's been a low demand and it's washed out some of the competition, but that competition will come racing back as soon as there's money to be made in that business. Just like anything else. I mean, look, if silver goes to $85, what happens? A bunch of people run out and open up silver mines, right? Any commodities like that. I mean, as soon as it crosses a certain threshold, people start looking and saying, say, you know, I can make some money on this because even though that mine hasn't been used in 20 years, I can get something out of it now at these prices. All right, that's you have to understand the dynamics of these commodities when you're playing with them. So you got in at 35. It's not far off 35 now. I wouldn't dump it, but what are you saying when you're saying you're holding it? You're not being the house, are you? You just bought the stock. All right, now potash. Let's find good old Yahoo here. All right, so let's take a look at potash. Yahoo will be right back. There you go. All right, their PE is 21. Their forward PE is a good quick way to see if you think something's growing is their forward PE is better than their current PE, so that's good. I'm not going to get into like a whole analysis of them. I mean, like I said, they're not a terrible company. It's just they're not a great company. I wouldn't pay a huge amount for them. They pay a nice dividend, 4%. All right, so that's kind of attractive. So there's a reason to own them for $35.11. You get your $1.40 dividend, but then the question is, how do you not be a sucker with it? So let's take a look at what we can do to protect you. So if you intend to own it for the long haul, very simply, you can take your investment of $35.11, right? You can sell the 2017 32 calls, and I would only sell them if I can get about $5. But let's say you certainly can, because you can get 4. He's got 643 here. Yeah, see these guys, you're getting 643 for the 30s. So you could certainly get $5 for these. So if you sell the $32 calls for $5, you're going to get paid net $37 to get called away. But don't forget, you're getting your $5 back, so your net is 30.11. So you drop your net to 30.11, and you got your $5 in your pocket. You only put $30 on the table now. You get called away at 37. That's a 20% profit, plus you get your dividend of $1.40, and you get $1.40 twice. It's another 10%. So just by simply selling the calls, you turn this trade from I wish to God I could make some money on potash to if potash just stays over. I'm sorry, what was the number we were selling? I'm sorry, we were selling 32. You're not going to make that. You're not going to make much of a thing. You're going to make $2 plus your dividends. What really turns it into, I'm sorry, I said that wrong. So if you sell the 32 calls for $5, you drop your net to 30. You're going to make $2 getting called away, plus you're going to make $3 in dividends over 2 years. That's $5. All right. So instead of just making the dividends on the play, which is 4%, you change the play to if it just holds $32, you're going to make I forgot the number now. 5. So you're going to make 15%, let's say 17%. All right. Now, if you want to make more money, what you should do is buy less. And that's confusing, but buy less potash so that you're in a position to double down, and then you could also sell the puts. And if you sell these $32 puts for, let's say, $4.50, now you've dropped your basis down from $35.11 to minus $4.50. So let's forget about the 11. Let's say that's going to be $25.50. All right, so now you got 25.50. You still pulled away at 32. Okay, and that means that you'll get a 6.50 gain there plus the $3 there is 9.50 on 25. So now we're talking about like substantial amounts of money, like 35, 40%. That's the way you want to play something like this, okay? That's the way you want to play any stock, because what did you do? You're being the house. That's what being the house means. You sold a lot of premium. Instead of buying a lot of stock, you bought a little bit of stock and sold a lot of premium. But bearing in mind, though, that if it does fall below 32, yes, you will have to buy more at 32, and then you've got your net. You still carry your dividends, though, so you have your net of 25.50 minus, if the dividend holds up, minus 3 of dividend puts you down to like 22.50. Then you have to buy more at 32, so your average is 32 plus 22 is 54, divided by 2 is 27. So you'd be averaging in at $27. But then that goes by to the next part of the thing, is if you don't want to own 1,000 shares of pot at $27, why the hell would you buy 500 shares for $35? It doesn't make any sense. You should never buy a stock that you don't want to double down on when it gets that much cheaper. All right, so that's the point of this thing, is that that way, instead of taking a lot of money off the table, you only have to take a little money to make a really nice return without tying it all up in one stock. Christy says you can take her with our membership fees, which have gone up. I'm sorry, I don't even know what the thread of that conversation is. All right. Jim says you can be stay deposit buying a bowl call spread. Yes, it's true. All right. And your daughter to a shoe. What? What is it, random phrase day? Your daughter to a shoe. Was I talking about my daughter? I forgot. Anyway. Let's see how things are going. My boy is still up, so I have $175. Oh, to dinner. Oh, a show. I'm like, what the hell is my daughter with shoes? Yes, my daughter to a show. Yeah, unfortunately, the show costs like $150 a ticket, so I really have to make $500 to take her to a show and dinner. See, but that's. By the way, I only like to play the futures for things like that. Like, I play the futures with a definite goal. Like, in fact, it's the same way I play, if I'm playing craps in Las Vegas, I do the same thing. I will take, I'm on my way to dinner in Vegas, and I'll say to somebody, I'll say, hey, I tell you what, we're either going to eat this cheap place that's good, or we're going to eat this expensive place that's good. And we're going to take, so let's say we're going to eat a $40 meal, or we're going to eat a $200 meal. And I say we're going to decide by taking $20 and playing some craps. And if we make $100 on the 20, we'll go for the $200 dinner. And if we lose the 20, we'll still go to the $40 dinner. It doesn't hurt much. I look at futures the same way. It's like it's just gambling, really. It's not like you can't look at this thing and say, this is how I'm going to make my living. You're betting on essentially binary events. Something's going to happen or it's not going to happen. And you try to make a bet, and you try to make a little bit of money. Now, if you take it in context and you bet it sensibly, you can consistently make small amounts of money. But you're not going to make gigantic amounts of money. That's what investing long-term is for. I like to play it because if you see things lining up a certain way and something seems obvious, you can do it and play some money. But I do it with the same logic, though. I'm always playing with a certain affordable goal. And I say, okay, fine. So I'm either going to lose $50, but if I do well, I have something in mind I want to spend some money on. Boom. It's good to do stuff like that because it keeps you focused. It keeps you like on a goal where you say, I am going to, I need to make $500, and once I make $500, I'm at my goal, or I can quit. You need to, and your goal can't be I need $50,000 to pay for college. That's not a goal. Okay, that's not a realistic goal that you're going to make in a day. I'm talking about you need to have a daily goal, an hourly goal, a monthly goal. You always have to have your goals, and you always have to try to see if you're on track or not. When something's not working, you should be able to see pretty quickly it's not working for you. All right, so for me, and I talk about that a lot of these seminars. So that's what we're playing for. I play for dinner. I play for shows. I play for trips. That's what I play for when I'm playing the futures. It's just extra little things in life. And if I don't win, I don't get the extra little thing. That's the other problem people have, is because if I lose, if I lose $100 playing the futures to take my daughter to the show, I don't take her to the show anyway. I'm like, I'm sorry, honey, we're not going to the show this week. That's all. All right, maybe next week I have better luck. But you have to have a governor on how much you're going to spend. You have to have an allowance for how much you're willing to lose in any given period of time. And you should never obviously lose money that you're not able to recoup. So in other words, if you're not working, if you're on a fixed income, you should have a much tighter amount of money. Like, you're not willing to lose any of your money because you only get X amount in per year or per month or whatever from your other investments. If you have a job and you're replenishing your account, assuming you have a job that you're putting money into a savings account. So let's say you have a $100,000 job and you save $20,000 a year, then that's great, because if you lose $20,000, at least you've only lost what you're going to put in next year. Your account's not going to be deteriorating or getting terribly behind. So you have that much to gamble with. All right, but if you have a $25,000 job and you're not saving anything, and you just have this $50,000 account from college or something like that, from all your college funds or whatever, and that's all you're playing with, you should be a lot more careful with the money. Because there's definitely ways, like I just said to Chrissy, there's very easy ways to set yourself up to make 10%, 15%, 20% every year with sensible option strategies that hedge your risks. They're slow and they're boring, and you have to be patient, but you're going to make a lot of money over time. This short-term trading crap is gambling. Don't ever think it's not. And gambling has to be very, very tightly controlled. And we talk about it a lot, and I haven't brought them on the seminar, I don't think, lately, so I'm going to talk about it now. We have an old friend of our site is Dr. Brett Stenberger. Let me see if I can, Dr. Brett. Darn it. Oh, there he was. Sten. This guy. And it's called Trader Feed. And in Trader Feed, Dr. Brett talks about the psychology of trading. I'm sorry, not in Trader Feed. Ugh, you're kidding me. Actually, wait, maybe it is Trader Feed. I take that back. Somewhere there should be a link to like a lot more stuff. Huh?
It's only November.
What the hell?
Hello, Claire.
Black Friday means sweet deals.
A new Ford with a $1,000.
Yes, I see that my computer has malware and viruses.
Any Ford you want. Everybody wants to make
Holy
Ford.
crap.
A great way to start your holiday shopping.
I cannot make this thing stop.
Amazon.com gift card and up to $500 cash back. Or lease a 2015 Ford Explorer for $229 a month at your local Ford.
Hang on, guys. Sorry about this.
Before they're all gone.
Oh, they can get rid of it now. Holy cow. I'm going to kill my daughter. This is my little one, actually. It's not my older one who wants to go to the show. It's my little one who messes around my computer when she's not supposed to. There it is. See, I can figure out from the task manager which one was annoying me, I think. Oh, maybe not. I don't want to accidentally end the show. That's the problem. Let's see if we can get rid of that. There it was. Thank you. Yeah, I know. Well, I mean, I have a password, but she knows it. Yeah. All right. So where were we? Dr. Brett, Trader Feed. Now I'm confused, so I don't think this is the right site that's for all his psychology. No, the problem is he loves to talk about. He's a great psychologist. He's not a good trader. So this is his trading site. Don't tell him I said that, please. But this one, Trading Psychology. Then there you go. That's right. He wants to be a good trader, but he's not. But the articles on trading psychology, I find, are so unbelievably helpful. And he has right here, the articles on market psychology. And, you know, there are books on this stuff too, and he's written a couple of books, and I recommend them also. Psychology of Trading is one of them. All this stuff is really, really important. There's so many articles here you can browse through for free, and I so recommend doing so. You gotta know yourself and understand yourself if you're going to be a short-term trader. You got to understand what it is that's making you feel like a certain way, and how you manage your money and how you think about money. All this stuff matters, and it's something that people don't really take into account. But I wish, you know, you really have to. Let's see if I can get rid of that too. There we go. All right, so it's Brett, B-R-E-T-T, Steenbarger.com. All right, in fact, wait, I bet I can probably put it into chat here. There you go. All right, so it's very, very good to understand psychology of trading and to get your head around like why you're doing stuff and how it's affecting you. These are things that a lot of times are not discussed and are not looked at, but they should be, because they really are important. Speaking of which, oh, look at that, $100 up in smoke. That sucks. Oh well, sorry, Madeline. Now let's see why. Because the dollar's at 88.70, it went up. See, it's exactly what I'm talking about. The dollar went up to 88.70. The indexes are generally performing well. All right, and that's my premise. I need the dollar not to be over 88.70. So right now it's kind of right on that line. So I'm probably not going to give up yet, but I'm not happy because I could have just cashed it up once. See, had I taken the 175 off the table, by the way, I'd be very excited about getting back in on a retest, right? But I didn't. So instead of having $175 in my pocket and ready to go again, I'm now hoping I don't lose the rest of my $175. That's pretty stupid, right? And that's why, by the way, though, I mean, remember I did say we should set a stop at 17.75, which was way back here, and we didn't. So there goes the money. All right, that's the thing about the futures. You really can't take your eye on it. You have to have a discipline. You have to set your stops, so on and so forth. All right, what else is happening in the market? Nothing exciting. Dollar here. Oil is interesting. Oil's down by 67.50 again, actually below it. Gold, 11.96, had a huge up. Look at that day yesterday. Everybody ran away, and then it went up $80 in one day. That is so completely ridiculous. So now it's just having a little bit of a pullback of $20, which is fine. Silver had a similarly gigantic move, $14 to $16. That's just an insane move for silver. That's $50 per penny. $5,000 per dollar. So it's a $10,000 move in silver off the bottom. But the thing is, do you have the balls to buy it when it's at the bottom? That's the problem. It's like when it's doing that, no matter how much you like silver, the gut reaction when it's doing that is like, how can you buy it when it's like completely liquidating? It's so hard. But it's a lot easier when you have cash on the sidelines to make those kind of decisions than when you're sitting there watching your trades go bad. And that's why it's so important to always have cash, especially this time of year, to have some money available to spend. TLT, I don't know why I was watching eBay, but it's zooming up. VIX peaked. So you can see the VIX peaked yesterday, and then it started going down. And as you see the VIX going down, you kind of assume the markets are probably going to be coming back. If the markets aren't moving, the VIX is dropping, something's going to change soon. Gasoline, 182. I wish that was being reflected at the pump. I know I just spent, I was paying attention. What was it? 280. I spent, no, 270 is what I spent yesterday for gasoline. That's a pretty big spread. It's like a 90-cent spread for these guys. Natural gas, like I said, it's 385 is a good point to play off of, and we'll see how that works out. And we got copper. You know, copper below $3 is a weak economy. There's no getting around that. If we're not using copper, it means we're not building buildings, we're not building houses, we're not doing infrastructure projects. You know, you need copper for all these things. Any kind of real building, you're going to have some copper going into it. And if we're not using copper for pipes and such, it just means that there's, I mean, I know PVC has cut into the use of copper, but realistically, copper is still the king of materials for that sort of stuff. And it's not a good sign for the global economy when you see copper below $3. That's just something you can look at immediately and say, okay, the economy cannot be that strong if you can buy copper that cheap. Chrissy is confused by GC. That's GC is just another kind of gold. Take copper out for now and look at GC. All right, so GC is just another kind of gold futures. I like YG. I don't look at GC. The U.S. dollar is going up, so that makes gold okay. Okay, the U.S. dollar going up puts pressure on gold and pressure on commodities and pressure on stocks, but it doesn't. Only in all things being equal is the dollar going to move gold. In other words, if the dollar's flat and there's a demand story for gold, gold will go up. If the dollar's flat and there's a lack of demand story for gold, gold will go down. But now if gold would have gone up 1% or down 1%, but the dollar moves 1% the other way, it's going to wipe out the fundamental move in gold. It's just a factor. You know, you can't, there's no direct correlation there. It's one of the factors. It's a big factor intraday. The intraday move of the dollar is very, very tightly to gold. And actually, even if you look long term, the longer term trends on the dollar and gold are going to be very tightly combined. But on any given midterm period, like over several days to months, you're not really going to see that tight of a correlation. It's just one of the many factors that are going to affect it from day to day. Okay, over the long haul, yeah, you'll see. But the thing is, when you see the dollar getting weaker, those same factors are the kind of factors that do make gold go up. And when gold gets strong, you know, usually it's because the dollar is weak. That's one of the primary underlying reasons gold is going to get strong, because people want to put their money in something besides U.S. currency. All right, and then we all know what we all know what the global currencies look like. I mean, look over here. No, wait, where is it? Oh, here you go. Look at these things. I mean, there's the euro, there's the pound. I mean, would you want to have your money in any of these things? 130. This is what, half a year. 140 essentially to 123. That's 17 cents out of $1.40. So that's like over 10% devaluation of their currency. Here's the pound, 170 to 156. That's a big amount. I don't know what that is. It's like 15% down. It's always saying 17%. Then you got the yen. Oh my God, 103. They got a 20% devaluation in their currency over less than 6 months. So talk about safety. Everybody's got to get into the dollar. All right, but that doesn't necessarily push gold down, because you're not the only person on the planet. What else are these guys doing with their money? What else is a Japanese guy doing with his money besides buying dollars? They're buying gold. So they're going to buy gold and they're going to buy dollars. So the dollar going up isn't necessarily going to make the gold go down, because the same factors are in place. These guys are abandoning their currencies. People are running out of the Japanese currency. They're running out of the euro. They've got to go somewhere. And you don't go out, you know, as an investor, you're told this all the time, right? You don't put all your eggs in one basket. Any financial advisor is going to tell them, try to diversify, buy some gold, buy some silver, buy some bonds, buy some stocks. You know, if you're going to start liquidating $1 billion worth of euros, you're not going to do it all into dollars. You're not going to do it all into gold. You're not going to do it all into anything. There's a lot of forces pushing money into stuff. And also, don't forget all the oil speculation money is probably pouring out of the oil market, and those guys want to go somewhere else. And what if you're a commodity trading fund? Then you have to put your money into some kind of commodity. So there's a lot of factors at play, and you have to realize that when you see gold, or you think gold is going down, but gold's not going down to these guys, right? If you look at the yen, can't do that. Let me see if I can figure this out on a chart. Hang on. Okay. Oh, every time. No. Die. Can we ignore it? All right, so if you look at gold, colon, and priced in yen, XJY. See if that'll work. There we go. All right, so this is what's going on right now. If you're a Japanese person and we're having this conference in Japan, what are we seeing? You're saying, holy cow, gold has jumped from 13.2 to 14.2. That's like almost 10% in the last 2 weeks. So is gold still the greatest investment in the world, or what? Because it suddenly had a big pullback today, and today it's way up there again. So a Japanese person is looking at gold saying, holy crap, gold is exploding. All right? What's the Japanese guy looking at? He's saying, well, here's gold. It was down a bit. It held the 200-day moving average, and now it's exploding upwards. And it already cleared all the overhead resistances it has for the last year and a half. And I think, chart-wise, I would say it's probably going to retest this high of 1550. All right. Now, 1550 is not a thing. This is what this is. It's the price of gold divided by the value of the yen. But you understand the concept. In other words, value of the yen is going down. So to a Japanese guy who's got to buy gold, this is what it looks like. Gold looks weak to you because it's priced in dollars, which is strong. But if you're in another currency, gold looks really strong right now. So what would you be doing? Buying it or selling it? This is what we had this conversation all fall. I've been telling you guys this all summer long. I kept showing you these charts and saying, look, you've got to understand what gold looks like to other people. Gold doesn't look bad. It looks good. It looks like someplace you should be putting your money to other people. It's better than it was last year. Last year, gold was 12. Now it's 14.5. That's up like almost 20%. Okay, gold is the best place to put your money if you're Japanese. Gold is the best place to put your money if you're European. You're just looking at it priced in dollars, and it doesn't look good to you. All right, so that's the big difference there. You just always have to be aware of that. Don't have a what's the word? Proud and prejudiced, but don't have a narrow-minded view of the world. When you're looking at trading, you've got to think in terms of the global market and how this looks to other people. And the same holds true for our market. Now, imagine how strong our stock market, or in fact, I don't think you have to imagine. I think I can show you. If you want to see, instead of gold priced in yen, let's take a look at the S&P priced in yen, SPX. There you go. Look at that. So you really have a more than 20. It's almost a 30% gain. It's like a 25. No, it's close to 30. It's close to a 30% gain in gold. I'm sorry, not in gold. In the S&P priced in yen from the October low. So we had that sell-off in October. And if you were Japanese and you liquidated everything and put it into yen, you would be so thrilled with this move up. Because it's priced in yen. Because you put your money into U.S. stocks that are priced in dollars, your currency collapsed, and the S&P went back up. And you make a fortune. To us, the S&P didn't do that great. But that's another thing, by the way, when I talk about, we were looking at the Dow before, and we're looking at how the Dow is priced. I think about that. I should talk about it more often. But that's what I think of. When I'm looking at this two-handle move in the Dow, in other currencies, we were talking about the 50-day moving average. You've got two full boxes here above the 200-day moving average. It's a much more severe move to the rest of the world than it is to us. They're seeing gigantic gains in the S&P. And they already see it as being, if you're a Japanese stock commentator, this is what you're looking at. You're saying, wow, that is the biggest, most overbought condition off the 200-day moving average since back in 2013, right before it crashed. And also the next time you can look back at something that big, which wasn't that drastic, was back in 2012, before it crashed. Other people are looking at different technicals than you are, because this is why I think TA is such a goddamn joke, because realistically, everybody in the world has a different TA. They don't have the same TA as you do. Their TA is priced in their currencies. And they're looking at charts, so the measuring tool they're using isn't the same as yours. And that's, and obviously we trade more U.S. stocks. When you look at U.S. stocks, you can use USTA. But when you look at foreign currencies, foreign countries, and you're looking at it in U.S. and trying to do TA on it, that's just a joke. And I always pick out chart guys I won't follow when they don't understand that concept, because I'm just like, if you don't get the idea that nobody in the world except you is looking at this chart that way, then you got a problem. All right. Rig is on the 15-year low. My thoughts on Rig, I think Rig's a disaster. We talked about this in chat. Look, seriously, every time I touch this thing.
Hi, Santa.
Hello, Claire.
Friday means sweet deals.
A new Ford with a $1,000 Amazon.com gift card.
It comes with
Die. I don't know how to make this stop. I'm so annoyed. I had an ad blocker. I don't know if somehow she disabled it or something disabled it. What is this? I don't know how to make it stop. All right. So, Rig. Right, we're going to look at that, and I tried to, but then Santa Claus came on again. All right. Now, wow. That's uglier than I even realized. All right, so, again, 15-year low, 20-year low, I don't care what year low it is. What I care about with Rig is that it's looking awful. It's in technical hell. You had a 44 to 27. So 44 to 22 is a 50% drop, right? So figure 22 is here. And there's your 50% drop. It didn't even hold the 50% line for any appreciable amount of time and just continued down. So this thing is in deep trouble. And I'm not entirely sure if it's going to stop or when it's going to stop. But what's important about it is you have to look at it and say, well, they're in a bad part of the cycle. I mean, this is what happens. If you looked at, let's see if we can go to Yahoo. Pick up a chart.
Attention,
Jeez.
Your computer might be at risk. For technical support, call the toll-free number that appears on your screen.
Wow. That is so annoying. No, it's not funny, Jim. I'm really pissed. All right. So, what the? I don't understand how this is possible. I mean, this is the worst virus I ever saw. It's just everything I do. All right. So let's take a look at Helvetia. And take out that. And I'll take out this. All right. And we'll go back 10 years. All right. So Hovnanian builder was up in 50s. It went up all the way to 60, 70 for a while. This is back in 05. Collapsed. Little recovery, collapsed, and then just dead. Okay. Meanwhile, though, you could conceivably traded it down here. It was at $1. It was at $2, and we were loving it when it was $1 and $2, and we were buying it, and we got out of the thing when it went over $5. And now we have it again. I think we have it about $4 or $3.85 or something like that as our net on the entry. So we're back in at 4. We think eventually housing will come back, but what's eventually? Okay, I mean, at this point, we started, I was anti-builder. Back here, all the way here, 2007, 2008, I was don't buy builders, don't buy builders, don't buy builders. Or we were shorting them, actually. We shorted all kinds of fun ones. Beazer, I remember Beazer loans was insane. We shorted until here. We didn't buy builders, really. I'm sorry, back here I did. I think Hub was one of the ones I bought in the crash. But we didn't really like the builders here. Only around here in 2011, we started liking Hovnanian again. I haven't really liked anything but other than Hub, and then we have some KBH, I think. But we're not we're not buying it because we think it's going to go up tomorrow. I just want to be there when it happens. It could go up, it could go down. If it goes to $2, I want to buy more. But I don't think it's going to make money this year. I don't think it's going to make money next year. I don't plan on it. And if it does make money, I'm going to take it the hell off the table. All right? Because there's still no clear indication of a cyclical recovery. Here's what a cyclical recovery, it doesn't have a longer thing? Yeah, it does. Here's what a cyclical recovery looks like. Now look at this. Before the buildings went crazy, They were down to the same damn place. This is what I mean by I just want to be here when it happens. I don't know when this is going to happen. I don't even know if it's going to happen. But what I do know is if it does happen, I sure as hell want to own some shares at $5 a piece or less. And then I'll get out when it's at 50 with my 10-bagger. And the way we play it is that we stay in it by we sell. In this case, we sold some puts. We have some stocks, so on and so forth. But our setup in the where is maybe the long-term portfolio, right? Ow, you are not doing this to me. Our setup in the long-term portfolio is pretty conservative, if I remember. That shows it to me. There we go. So where is Hove? Oh, no, we don't have it. I'm sorry. We have maybe in the income portfolio. Now we've liquidated. So in the long-term portfolio, we have it. Oh, it's net 405 entry. We sold the $5 puts for 95 cents. Now you can sell them for $1.50. That means you can net into Canadian for $3.50, even though it's at 417. So I still like that play. But this is not a high conviction play. What we're saying is I will buy 4,000 shares of Canadian if it's at net 305. I'm sorry, 405. If it's a net 405, I'll buy 4,000 shares. I'll own $16,000 worth. Now, since our allocations in the long-term portfolio are $50,000 blocks, it's not using even very much of my allocation, is it? So if it falls to 2, I'm perfectly fine buying 4,000 more shares at $2. Then I will average 8,000 shares at $3. And how much is that? That's $24,000. That's only half of an allocation too. And if it falls to $1, now again, assuming I don't think they're going bankrupt or something, if it falls to $1, I'm very happy to buy 8,000 more for $1. Then I will have spent $32,000. I still haven't spent a whole allocation block, and I'll have 16,000 shares of Canadian for $32,000, which is what? About $2 a share on the average. That's how I want to buy Canadian. I don't care when that happens. I don't care how it happens, but that's my plan. My plan isn't to make 50 cents I'm sorry, $1. My plan isn't to make 95 cents on 4,000 shares. My plan is to eventually own 10,000 shares, 20,000 shares cheaply, cheaper than it is now. My consolation prize, if Canadian goes up, is I'll get my 95 cents. But that's how I'm working into a long-term position. Any commodity play, anything that's in a cyclical downturn that you get into, you should be having a plan like that you plan on going in over the long haul and doubling down. See, KBH, we only have 10 short KBHs. So in KBH, I said, okay, we're going to sell the $15 puts for $2.50-ish, about $2.50, and we're going to be in for $12.50. I'm willing to buy 1,000 shares of KBH for $12.50. It's the same thing I'm doing with Hub. It's a cyclical stock that's in a cyclical downturn. I don't know when it's going to turn around. I just want to be there when it does. So I'm going to buy a position. I'm going to make it a small part of my portfolio. I'm going to add to it if it gets cheaper. And if it doesn't get cheaper, I win. So what's my view on RIG? What do we have in RIG? Do we even have it right now? Yeah, here you go. In RIG, I don't think I have a full position in RIG, do I? No. We liquidated that too in the income portfolio. So in RIG, we sold the 27 puts. We're very underwater on these. We sold the $27 puts, 20 of them. That's a lot. For $8, we thought that was going to keep us safe. That gave us a net of $19. We're in where we are now, in fact. So our net is $19. These are showing a loss, but in reality, if these are assigned to us, we're actually up 50 cents. And they're 2017s. We have a very long time for it to play out. So I'm certainly not inclined to do anything with it at this point. I feel that that's about the right price then. About $27 should be about the right price 2 years from now. I'm expecting things to come back by then. But that's all. So, what are my thoughts on RIG as far as that goes? I think that they're a good buy at this price at 19. I think you have some great opportunities to sell puts. You don't have to be as aggressive as we are there. We took a pretty aggressive stance. But let's take a look. So if you look at the 2017s on RIG to initiate a position, let's see what we got. Look at that. You can sell the $15 puts for more than $3. That's a ripoff. I wouldn't say. I mean, you can see 291, 360. So you just divide between the two. The 70 cents between them. Figure you get at least 30 cents from 291. So that's at least 320. That's the least I would possibly take for that. So I'd ask for 330. You sell those for 330. You're into rig for 1270. All right, and 1270 is still $7. You know, not $7, $6.50 below where we are now, which is a third lower than it is now. And I think that's a fantastic play. I think it's a great entry. We already have some. We already sold the 27s, so I'm not inclined to do anything about it as far as it goes in our portfolios. But as far as a trade to enter it, you know, yes, but yes to an amount that you're going to be happy to double down if it goes to 10. Yes to an amount you're going to be happy to double down again if it goes to 6. Because, you know, when you're in a cyclical downturn, you don't know how low the downturn is going to go. You don't know how far it's going to take you. All right, so keep that in mind. I mean, that's so when you talk about these stocks, all the oil stocks right now, you're in a cyclical downturn. What if oil goes to $20? It's not likely, but it could happen. It went to $20 before. It could go to 40. So, you know, it's not like I want to jump leaping into these sectors. And we have some XCO, I think we still have. You know, we have some of these stocks, but we have them because it fits our long-term strategy. When that sector comes back, we're going to be in extremely good shape. But it's not a one-year bet. It's not even a 2-year bet. It's like a 5-year bet. You know, and you look at this chart, wherever it was, this is what we're betting on. But we could be here, or we could be here. We don't know. And frankly, though, really, if you think about where rig is now, rig is here. They're only just crashing. All these oil stocks are just crashing now. It could take them, this is 5 years. It could take them 5 years. It could take them 10 years before things start turning back around. I don't think oil is going to take that long to turn around. I don't think, it's hard to tell those because we have changing dynamics. I just wrote on, was that my post? I don't know. I just wrote in a post like the other day. I was writing about the changing CAFE standards of the auto industry and how there's a long-term detrimental effect on oil. Demand is long-term under pressure. Supply is not under pressure. Demand's under pressure. Oil demand is just going down and down and down, and supply is not going away. That's going to make it cheap. It's not likely to recover at any major extent. What's been wrong has been the price above it. I've been saying this for God knows how long, right? What's wrong about oil is $100. That's the thing that's crazy. $70 isn't crazy. $70 is what it should be. $70 is the right price for oil based on the supply and demand of oil on the planet Earth. $70 is the correct price. So just because we finally got back to the correct price after some craziness doesn't mean that that we're going to bounce back to a high. It should probably drift around here for quite a long time. All right, and also when you say that, if I think 70 is the right price, and by the way, I wrote this. It was linked in the article I was talking about. I think I wrote that in like 2009. I was trying to tell people like that's the right price or whatever. Not 2009, but whatever year it was. I was writing about the Goldman oil scam. But when oil was first getting to be 100, I was saying 70 is the right price. 70 is the right price. It can go $30 up. That means it can also go $30 down just as easily. So at 40, I'm very bullish on oil. At 70, I'm not bullish on oil. It's just the right price. It's like being in the middle of a trading range. Move on. Find something else to trade. And that's why we haven't been making a lot of oil trades, because really it's unfortunately the easy money has been made in oil. We made it. We were short on oil, relentlessly short, from $107 to $67 for the last 40 bucks. We've been short all the time on oil, except for a few bounces we played. But now that trade's done. I don't want to short oil. I don't know if oil's going to go up or down from here. I think it's going to settle around this price. We have some bullish USO trades, but that goes out until like April of next year. I expect by the spring we should have a little bit of appreciation in prices. It might not, though. It might go lower. And if it goes lower, though, then I'm willing to get more bullish because I like the price better. Just like rig, I like the price at 25 bucks. you know, our net, don't forget, we didn't pay $25, we paid net 19, but at 27, we sold the puts that put us in for net 19. So I like the price when it gets around 25. I like to be able to sell puts and give myself an additional discount. That's a good deal to me. But it doesn't mean that I expect them to turn around quickly. I just think that's a good price. I'm willing to pay 19 bucks a share for RIG. I'm willing to pay 4 bucks a share for Hovnadian. You know, that's the concept of the buy list. That's what we're doing with these things. Those are the prices we're willing to start an entry. From there, we want to be the house. We want to sell premium, so on and so forth. All right, so we've got to close this up, so we'll see. If you have a question, answer it now, or forever hold your peace, or at least until next week. Where did our portfolios go? Here we go. So as a quick thing, the LTP is at 20%. That's fine. And the short-term portfolio, let's see how that's doing. What? How did that happen? That's messed up. I would imagine something's mispriced. The June 35 SQQ. Is that what happened? I have to look now. Sorry about that. I don't know what happened, but somehow in the last couple of hours, this thing has changed by 20%. I'm not quite sure why that would have happened or what particular thing did that. Something has drastically changed here. Maybe there's an entry that got messed up. I'll have to look it over because that just seems crazy. It's anyway, so it says 54% now. It was saying 70% this morning. And I honestly haven't got a clue as to how that happened. And let's see what else we have. We have the butterfly portfolio. That got hit also this week. Doesn't make sense. It can't go down $20,000 in a day. That has to be mispricing. Yeah, the butterfly dropped to 14%. And we'll have to make some adjustments. Probably tomorrow we'll have to start looking at some of these portfolios to making some adjustments. And then we've got our $25,000 portfolio, which I don't think is doing so well either. Not so bad, 17%. We'll have to do something about these DXDs, but again, I want to wait. We have these USO longs, but they're for April, like I was saying. We still have to think about maybe doubling down or rolling those. We have these, we already have EWJs. I didn't even know that. We have these EWJ puts. I was just going to get some more today because I like where the Nikkei is. At 55 to 40 cents, I wouldn't change this position, but I do like this position a lot. I like these EWJ January $12 puts for 40 cents. I think they're a fantastic buy right now. In fact, I think I'll do a top trade on those. I think it's going to be really good payoff. GMCR is dead. That was a shame. And then we've got our little BTU spread, and I think we talked about adjusting that, didn't we? Yes, we made an adjustment for that in chat. And our adjustment to that was, let's see. Gotta be kidding me. I am going to change my password on this computer. You're right, I can't take this. It's just crazy. I don't know how she does it, because she has to, what was I just looking for? BTU? No. Yes, it was BTU. Okay, so officially on BTU, our adjustment is this one. It's getting 35 cents back for the December 10 calls, spending 75 cents to roll them to the January 9 calls, which are $1.10. And when the December 11 calls expire, then we can sell the January 10 calls and pick up some more money. That's our plan for that one. And that's it. But we'll get more into the adjustments tomorrow in chat, and that'll be enough for today's webinar. Thank you all for attending. I appreciate it. And we'll do this again next week, all right? Thanks.